Welcome to TQS, the Quick Study channel. This channel was created to help you learn any topic in the fastest way possible. Today we're going to dive into the reasons why the Silicon Valley Bank collapsed. But first, a brief overview of the bank itself. Quite surprisingly, this bank a month before its collapse was rated the 16th largest bank in the US with assets of over $209 billion. It is the biggest bank failure since the 2008 financial crisis and the second largest in US history. The bank was once a dominant player in the tech industry and the go-to bank for entrepreneurs and investors. However, in 2023, the bank made headlines for its financial troubles and it eventually collapsed. So, let's take a look at the reasons why the bank failed. Silicon Valley Bank's primary focus was on the tech industry, more specifically tech startups. While this helped the bank grow and become a dominant player in the tech sector, it also made it vulnerable to any economic downturns in the tech industry. Tech startups rely on investments from investors before they start to generate profits. They are like any other business, they have costs like employee salaries and other overheads. But they are not yet fully able to generate a profit, so they raise capital from investors and deposit it in the bank. When they require more funds, they raise more from investors. During the pandemic, the interest rates were low, so tech startups were easily able to raise capital. Therefore, they had excess cash to deposit, and Silicon Valley Bank was the most popular bank in Silicon Valley for tech startups. This helped the bank's cash deposits to grow at a phenomenal rate. Due to the large influx of cash, the management of the bank wanted to invest the increasing deposits. Therefore, they invested in long-term U.S. Treasury bonds. They invested in old Treasury bonds which paid a higher return rate compared to the newer bonds which had lower returns. But just as the world began opening up after the pandemic in late 2021 and 2022, inflation began to rise. This caused the Federal Reserve Bank to increase interest rates. As the interest rates rose, the new bonds began to pay higher returns. This made the old high-yield bonds less appealing in the market, which in turn decreased their market value. This heavily affected the bank's billions of dollars worth of investment. Due to high interest rates, tech startups were having trouble securing more funding, so they started to take their deposits out of the bank. This caused the deposits to decrease and the bank was forced to slowly sell its investment in bonds at a loss. Eventually, the bank sold all of the bonds and took a $1.8 billion loss. The bank's management decided to raise capital, which caused a panic in the market which affected its stock value. This further created a panic withdrawals from depositors. Within a few days, the bank collapsed due to panic withdrawals and stock value drop. In conclusion, the Silicon Valley Bank collapsed due to a combination of factors, including its heavy reliance on the tech industry, lack of diversification, and poor management decisions. The bank's collapse serves as a reminder that even successful institutions can fail if they do not adapt to changing market conditions and maintain good corporate governance practices. The reason for creating this channel was to teach myself and to help you understand this topic in the quickest way possible. If you liked this video, kindly like, share, and subscribe to help grow this channel so that I continue making such content in the future. Thank you for watching, and I'll see you in the next video.